So a seasonality on the horizon, this week's rebound, do we think a year-long rally, year-end rally is coming, Guy?
Gobble, gobble. I had to say that. Happy hump day. Let's get it out of our system now. Okay, it's out. It's amazing. You know, Tim talked about this the other day. The fact that last week I was talking about the potential for an outside month to the downside when the S&P 500 was 6,500-ish. We had made a new all-time high in the month of November. We were flirting with the lows in October. They defended the 100-day moving average, and here we are 250 or so handles higher. As a matter of fact, if something weird happens on Friday, you could have an outside month to the upside if we close out all-time highs. That's not out of the realm of possibility given what we're seeing. You mentioned the VIX getting tame again. It was absolutely showing warning signs a week or so ago. Yields coming down, even Bitcoin getting off the mat, all good things. And I got to tell you something, as we get into December, as bearish as I want to be, it's very hard given the calendar. You know,
when you look at people and funds into year end, the reason why it's historically a positive sign or a positive seasonality for the market is if you're long the market, you want to see your stocks go higher. If you're underperforming the market, you want to average or you want to dress those positions up. So not saying that they're market manipulating, but you're more apt to buy this dip to make your existing positions look better than worse. So you know how we always talk about the Fed and are they the biggest thing for the market? Well, did this week prove that? I think pretty much people are still worried about the Fed, right? So worried about Powell got a little more hawkish. That sent the market lower, and now we see a little more dovish, and the market's higher. I think it's as simple as that.
Yeah, we had Waller on Monday telling another network that he would be inclined to cut rates. We have J.P. Morgan this afternoon flipping and now seeing a cut in December. Tim, so it does seem the Fed is a force in terms of Fed cut. Great for the markets. We are, clear for that. There's a glide path forward.
There's that glide path, and the Fed's always a force. I mean, the fact that I don't think we're debating it. So let me just say, I thought it started last Friday, and that's what turned the market was the Fed's Williams, New York Fed, arguably the most important Fed. And so you combine that with what was, it's a week, by the way, that forgot NVIDIA. It's the week that NVIDIA forgot. And ultimately, the dynamic here is it's a great show for equities, given that leadership coming from the semiconductors, which did lead, but not by NVIDIA, was there. So J.P. Morgan, the aforementioned, there they were upgrading their S&P to 7,500 next year, but they said it could actually be closer to 8,000 if we have a more dovish Fed. They qualified it and said we could go even higher. But at the root of they and other houses on Wall Street are the quality of earnings. And that really is, I think, part of the story here. This year-end rally and off of those lows, those intraday lows from last Friday, you've got almost a 10.5% move in semis. You've got a almost 6% move in the NASDAQ. Dare I utter the word small cap in the same sentence? And they rallied almost 8%. And so the question for investors often is during these bouts of volatility, should you be doing anything or you should be buying? And I'll just add one more thing, is that retail showed both last Friday and on Monday, and this is actually data I got from J.P. Morgan, which is that they had one of their highest buying days, up days on Monday, a 94 percentile up buying day on Monday after the kind of fallout from Friday. So I think retail's alive and well, and I think the market's going higher.
And retail's largely been right all year. Mike Coe, what do you see here going forward?
Well, you brought up the VIX at the very beginning. Two things about that. The first is that we've seen multiple times this year that when the VIX has gotten north of 25, that represented maybe a little bit of excess fear, a slightly oversold condition. And it seems like that was reiterated again very recently. The other thing about the VIX I would point out is that just because of the mechanics of how it is calculated, it looks 30 days in advance and is estimating the volatility that the S&P is going to experience over that intervening 30 days. But there would normally be, 22 trading days in that session, in that period of time. Now we have slightly less because we've got a half day Friday, we're off tomorrow, and then we have a half day on Christmas Eve, and we're off on Christmas. So in that 30-day window, we're actually 3 days shy of the 22 you would normally experience. So the VIX is actually slightly higher, and it's on its way down. What does that tell me? I actually think there could be a little bit more room to the upside here because it seems like that oversold condition probably could run, a little bit further from here.